Hello, I'm Debbie Bell-Hosking for Finextra TV here at Sibos 2023 in Toronto, and I'm joined by David Loeser, and we're looking at trade finance. Is it the weakest link? David, welcome.
Thank you. Thank you for having me.
Absolute pleasure. You heard my question there, but let's see what evolves within our discussions. The trade finance gap, that's a term we always hear. What exactly is it, and what's behind it?
Sure, the trade finance gap is a measurement provided by Asian Development Bank, where they're measuring the amount of trade finance applications and those that get rejected for various reasons. What it really is a proxy for what are the types of organizations that are trying to finance their trades but not able to get that financing, so almost like an underbanked type of sector around trade. The reason why this gap is growing, so it's grown nearly 50% over the past 2 years to over $2 trillion in terms of the gap. There's a multitude of factors, but mostly around the scrutiny and the difficulty in identifying red flags and assess and mitigate risk around trade. So this impacts actors of different sizes in different ways. So with large-scale global players, with this additional scrutiny and the additional cost that goes to identifying those risks, it changes the economic value proposition of that business in those areas, and so they're looking at de-risking and moving out of those areas. Whereas the small regional players that are probably more close to those organizations applying for that trade finance do not necessarily have the tools and resources in place to effectively assess those risks, and so they are also similarly challenged in providing that trade finance as well. So what we have is this additional scrutiny, the additional risks related to trade finance, creating this gap where financial institutions of all different sizes are not comfortable providing as much trade finance as what's necessary for the market. So we see this as similar to the underbanking type of issue in other geographies.
And what about regulations? I mean, how are they changing in the industry, and how also are the regulations impacting financial institutions, cargo carriers, insurance companies?
Yeah, so the regulations are changing significantly. So there's a lot of scrutiny, and I think this is on the back of everyone recognizes that trade-based money laundering is a real issue. It's an issue that masks illicit gains from nefarious activities like human and drug trafficking. It supports the financing of terrorism. It's also used for tax evasion in certain economies, which can bleed the coffers of some of those emerging markets. So trade-based money laundering is the focus of a lot of regulators. There's been a lot of guidance and new regulations been released globally that are, again, increasing the burden or the focus on those risks related to trade and trade compliance. So for an example, like in Bangladesh and Malaysia, they're starting to increase the need to do container level tracking to ensure that the good that you're financing, you know exactly which container on which ship, and if that container switches ships, it's a regulatory requirement to be able to manage that. So this is maybe an indication of a trend where more granularity, more deeper investigation into the goods and where they're going being pushed on financial institutions as well as other parties in the market. Historically, FIs have been the regulators' remit and really the best suited to identify these risks, but they're starting to ask to share the burden, to spread that out to other players within the ecosystem.
All right, thank you, David. And earlier in our interview, you mentioned red flags. So what sort of red flags do you get?
Yeah, so there's a lot of red flags in a trade. So mostly around the vessel and the container, as well as the good that's actually being shipped, and any sanctions evasion or any sanction-related risk. So as you would normally do in any financial transaction, you're screening all the parties involved. With trade, it's very different because there's so many different players. The trade takes quite a long time, and so the regulatory list can shift during that time. But so it's any sanctions exposure within the vessel, any of the vessel ownership structure. If that vessel has historically made journeys to sanctioned or high-risk countries, if they've engaged in historical ship-to-ship transfers or had AIS anomalies, so AIS is the transponder that says, I am this ship, I am in this location. So you can look at any of those instances from a vessel's history and say, actually, I don't know if I want this vessel carrying the cargo that I am financing because they've made a trip into a sanctioned area. So that's around on the vessel side. So is it going where it's supposed to be going? Is it stopping by and going into anchorage at a sanctioned or high-risk port? On the other side, you have the goods. So dealing with dual-use goods or any other types of controlled goods. So there's only certain types of goods that you can ship to certain areas. So chlorine is a good example. So chlorine can be obviously used in a lot of household cleaners and used for what I'll call normal civilian purposes, but then chlorine can also be used in military use. And so there's regulation in the EU and the United States and a number of our geographies to say, these are the types of dual-use goods that we want to identify, and if you see them, you need to do a little bit more investigation to ensure that your good that you're shipping is being used for the civilian purpose and not being used for the opposite of the military effect.
Wow. And there's so much to track.
Yes.
So that leads me to digitalization. It's a word we hear pretty much every day here at Sibos, digitalization. So how does that impact the industry? And also, could it help close the trade finance gap? I
think it definitely could. But I do think on the net it is a positive. So the digitalization, getting a historically manual, document-centric trade finance department to digitalize the documentation, be able to pass it through the normal channels, to be able to do their screening and effectively understand what's going on, is a huge boon for the industry. Being able to get away from any OCR typos or issues where you don't actually have high quality data to assess those and identify those red flags I mentioned earlier. So that's where it's a huge improvement. On the flip side, there is this move to digitalization is opening up the surface area for other types of fraudulent attacks. So I think it was mentioned in a panel earlier that of the there's 29% of trades that were identified as trade-based money laundering actually had digital documents altered, and that's a big issue that digitalization has. Everyone thinks that it may solve all the world's problems, but at the end of the day, there's still manipulation, there's still issues around trade-related documents that are, even if we digitalize, it'll still be difficult to find.
David, thank you. It's been a fascinating discussion, and of course, we did ask at the beginning of our interview whether or not trade finance is the weakest link. How could one approach that in an answer, do you think?
I think the focus that we're hearing from our customers, from the market, from the regulators, indicates that it's, if not the weakest link, an area that needs to be shored up. It is in a digital world. We still work with physical goods, and so making sure that they are going to the right actors, used in the right ways, and protecting the overall financial ecosystem, because using trade as a way to move illicit gains outside of normal what I'll call payment rails is a way in which bad actors are moving those funds and supporting those illicit activities.
David, thank you. It's been a fascinating discussion.
Thank you.